Good morning, students. Today we will start with FAR 7, right? And this is one of the most important topic of your curriculum, accounting for income tax, right? When we did FAR 6, accounting changes and error correction, over there in case of retrospective application, you need to show cumulative direct effect. And we need to change the carrying value of asset and liability with corresponding adjustment with the opening balance of retained earning net of taxes, right? So when we did accounting changes, I have introduced you with the concept of deferred tax, but today we will talk more elaborately. Okay, now first of all, when we get into the concept of deferred tax, we need to first understand there are two set of books are maintained. One is as per US GAAP, right? And another is as per income tax law. When we follow US GAAP, there are a lot of accounting principles like prudence, right? Realization concept, many other accounting principles we follow. But as far as income tax law is concerned, in income tax law, there is no such concept of prudence. Whatever is actual, they take that, right? So, the very first point, two set of books of accounts are maintained. Number A, is accounting profit as per FASB, Financial Accounting Standard Board, GAAP rules. And number B, taxable profit as per income tax law, that is IRS. Right? Now, when we find out accounting profit, right, we take sales less COGS, and then we subtract operating expenses, right? So this we have done in FAR 1, the proper income statement format. We get operating profit, then we add non-operating income expense, so we get profit before tax, then we subtract taxes and we get income from continuing operation, right? So if I simply give you the income statement format, we have sales less COGS is gross profit less operating expenses we get operating profit plus oblique minus non-operating income oblique expense, we get profit before tax less taxes. So we get income from continuing operations, right? So basically it is like this, then minus this, right? Now when we subtract these expenses, right, with respect to some expenses we take the provision figure, like we might have some contingencies. So in case of contingencies, we have learned in FAR 6 that when it is probable and estimable, so we accrue the most likely amount, and if most likely amount is not given, then in that case we accrue the minimum amount, right? Slowly I will build the concept, right, which is more important. So this part we are going to study here, right? And these are our expenses. These are expenses. Right? Is it okay? Right? Now, so in case of contingency, I had told you that when it is probable and estimable, we show the amount of accrual, the most likely amount. If most likely not amount is not given, then we accrue the minimum. There is no such concept in income tax law. Income tax law is very simple. Until we incur actual expense loss, we do not accrue it. It means whatever amount of provision or allowance we are creating in accounting profit, right? This income statement is as per US GAAP, right? This is US GAAP, right? So whatever profit that we have reported here, it may not be same as taxable profit, because while calculating this income from continuing operations, we have considered all expenses and incomes, right? So that may not be the case in income tax law. Further, we have learnt in accounting changes, right? We were following completed contract, and in income tax law we are following percentage of completion method. So the amount of revenue we will report in case of completed contract and the amount of revenue we will report in income tax law is not the same, right? So there are various items due to which my accounting profit will differ from the taxable profit. Now, how do you arrive at taxable profit? Right? How do you arrive at this taxable profit? Because on that taxable profit, we have to calculate these taxes. This is pre-tax accounting profit. What it is? Pre-tax accounting profit. Right? So there are so many expenses which may not be considered by income tax law, either on permanent basis or on temporary basis. Like, suppose we are paying some kind of fine or penalty. So when you are paying fines or penalty, you will show in these expenses, but it is never considered in income tax law. But suppose if I am paying a penalty for breaching a contract, so breaching a contract is a part of my day-to-day activity. I entered into one contract with you, right? After some point of time, I might breach it. It's a part of my business act. Maybe I'm getting that raw material at a cheaper price at other marketplace. So why will I honor you, right? Suppose I have done a contract with you that I will purchase from you at the rate 45 per kilo. Now the market price has come down to 35. So will I go for this contract? No, I will cancel it. And when I cancel, I have to pay you some penalty, 2 rupee, 3 rupee, whatever. It was mentioned in the contract. So if I am cancelling this contract, obtaining it from the market directly, adding the penalty amount, my cost is still lower than what it was contracted for. So anyway, I will not go for that. I will cancel the contract. So it's a part of my day-to-day activity. So breach of contract is not, it's a crime, right? If it is in my favor, I might breach it. Clear? So breach of contract is considered in income tax law, but penalty for violation of law, fines paid, so that particular expense is never considered. So there are some expenses which are time being not considered by income tax law. They will consider it when that actual expense happens, like contingencies, like allowance for uncollectible debts. But there are some expenses which will never be considered by income tax department, like fines, penalties. Right? Here we have non-operating income. So suppose I have got some, I have invested in some municipal bond and I have got interest on that. So that's a non-operating income. But on that particular income, it's exempted income. On that income, we don't have to pay tax ever. Right? So ultimately, we will find that there are some items which are for the time being not considered in income tax calculation, in taxable profit. But later they will be considered. And there are some which will never be considered. Anyway, we will get taxable profit. Either I can go a fresh calculation for taxable profit, or I can go for indirect calculation. Like I will start with income from continuing operation or pre-tax accounting profit. I will start with pre-tax accounting profit, right? and I will do all the adjustment which is not considered in income tax law. Right? So usually what will I do? I will start with pre-tax accounting profit. So there are some expenses which will never be considered in income tax law. So I will add back those expenses. Add expenses that will never be considered. Add expenses that is not considered for the time being. Right? Less. Now in this pre-tax accounting profit, there are some incomes which is considered, but it is exempted. It will never be taxed. So what I am going to do? Less income that will never be taxed as per income tax law. Less income that is not taxed for the time being. So when I do all these adjustments, so I get taxable profit. Right? Is it okay? Fine. So the items due to which there is difference, right? The item due to which there is difference between the pre-tax accounting profit and taxable profit are either permanent differences or temporary differences. For differences which are permanent in nature, future tax liability will never change. But differences which are temporary in nature, future tax liability will change. Yes or no? So whenever due to any difference there is a scope of change in future tax, deferred tax liability and asset will be created. Like in COGS, suppose we have depreciation of plant and machinery. Suppose we have depreciation. In accounts, we are following SLM method, but income tax law is following accelerated method, that is double declining balance method. Depreciation is being considered in both the laws. GAAP is also considering depreciation. Income tax law, IRS is also considering depreciation, but amount is varying. Yes or no? But ultimately, if I combine financial statement of all the years during which the asset was owned, total depreciation will remain the same. It means due to some items, it is coming in both the books, but amounts can be different. So that is again temporary difference, not permanent difference. Is it okay? Tell me. So, expenses that will never be considered. These are permanent differences. These are temporary differences. This is permanent difference. This is temporary difference. Right? So when I reconcile a pre-tax accounting profit with taxable profit, there is differences. Like we have done BRS, check deposited not yet credited in bank account, check issued to supplier but not yet presented for payment. Similarly, expense shown in PL means GAAP, will not be considered in income tax law. So the expense which is considered in PL, it means pre-tax accounting profit is lower. So now increase it. Either permanently or for the time being. Anyway, this is not considered this year, add back. Income which are not considered, subtract. So when I do a lot of adjustments with this pre-tax accounting profit, I get my taxable profit. Yes or no? So what are taxes? Taxes means taxable profit into tax rates, right? Taxable profit into tax rates plus deferred taxes. So this is current tax payable and this is future tax liability or asset. Suppose expense which is not considered for the time being. So due to this expense, my current year taxable profit is high. I have increased my taxable profit. So as a result, today I am paying less or more? More. In future, when this expense will be considered, in that particular year, I will pay less tax or more tax. It is a savings. So it's a deferred tax asset. I will subtract it from here. Income which is not taxed for the time being. So as a result, my taxable profit is lower. I'm not talking about those income expense that will never be considered. That are permanent differences. We are only going to look for temporary difference. So deferred tax is created only for temporary differences. So the income which is not taxed today, in that case what will happen? My taxable profit is low. So currently I am paying low tax, but in future I have to pay more tax. So I will create deferred tax liability. So I will increase it. So when I do deferred tax, liability I will add, asset I will subtract. Is it okay? Right? We'll come into these concepts slowly. So simple funda, when we are paying more today due to temporary difference, then we will create deferred tax asset. When we are paying more today due to temporary difference, then we will create deferred tax asset. When we are paying less today due to temporary difference, then we will create right? Is it okay? Due to permanent difference, my future tax liability won't change. Whatever change it has taken place in the current tax. Is it okay? So when I prepare pre-tax accounting profit, I consider all income, all expenses. Out of those expenses, some might not be considered at all forever, or some may not be considered for the time being, or some are considered but the amount is different. That is also temporary difference. Same goes with the income as well. Right? So permanent differences are those that will come in either of the books. Either it is pre-tax accounting profit or taxable, not included in both, today or tomorrow. But temporary difference, it will be included in both, today or tomorrow. Right? So, if I give you list of expenses and incomes, right? So when we talk about permanent differences, items of expense oblique revenue that are not deductible or taxable under income tax law. Not included in both. Right? No deferred taxes as there is no future tax consequences. Right? So now I am going to give you list of expenses which are not deductible under income tax law and list of incomes which are not taxable as per, or rather which are exempted, right? So we start with pre-tax accounting profit, add expenses not deductible under IRS. So these expenses are not to be considered. Like I told you, fines, penalties, right? Like meal 50% is only allowed, so 50% will be disallowed. So there are certain things which you will learn when we do thoroughly this regulation part. But for doing this particular topic, it is not necessary that you should know all the regulation topics, right? Like entertainment expenses, life insurance premium where company is beneficiary. This is also not considered. right? So we have less incomes which are exempted oblique non-taxable. Life insurance proceeds on officers, state and municipal bond interest income. Right. Now there are some special items which not considered in GAAP but IRS. It means again this is anyone. So due to this also it is permanent difference. Now what happens, suppose I am working in special economic zone and I have done an expense of 1 lakh. Now government, in order to promote these type of expenditure, what does the government say? Fine, you incurred 1 lakh, but I will give you deduction for 1 lakh 50. It means I am getting some special deductions or excess deductions, like in India we have. So that amount is not considered in GAAP, but excess deduction which I am getting. So we have some excess deductions of expenditure incurred. So this will be subtracted. Right. Now there are some special tax allowance also. Like dividend income is included in accounts. Dividend income is taxable in income tax also. But there are some dividend income which is not taxable. So that I am going to less dividend received deduction. So when I do all this activity, right, I get my taxable profit. So these are those items due to which there will be no deferred tax. Simply it will affect my current tax, as it will never be reversed in future. Now what is reversal? Reversal means today not allowed, tomorrow allowed. Today allowed, tomorrow not allowed. This is reversal. Today not taxable, tomorrow taxable. Is it fine, I guess? I think this is absolutely okay with all of you. Right? Now we will talk about temporary differences. Temporary difference is also known as timing difference. It will reverse themselves in a matter of time. It will reverse themselves in a matter of time. And affect the deferred tax computation by creating DTA oblique DTL. Like, I will give you a lot of examples through which I will explain you how does it work. Suppose I have purchased one machinery $1 lakh, salvage $10, life 5 years. So as far as GAAP, we are following SLM, and IRS we are following DDB. Now tell me, year on year, what is depreciation as per GAAP? $1 lakh minus 10,000 by 5, that is 18,000. 18,000 depreciation as per IRS. Now DDB percentage is 1 by 5 into 2. Yes or no? 1 by 5 into 2, which is 40%. So 1 lakh into 40%, that comes to 40,000 in the first year. Yes or no? Second year it will be 60 into 40%. Right? Third year it will be 36,000 into 40%. First year carrying value is 1 lakh into 40%, 40,000. Second year carrying value is 60,000. 40% of that is 24,000. Third year carrying value is 36,000. So 40% of that is 14,400. Right? Now we have 21,600 into 40%. How much? We have carrying value of 21,600, right? How much? 8640. See, anyway, this total cannot be more than 90. Right? Then we are left with 12,960. 40% of that is, but maximum depreciation will be 2,960. Right? So over 5 years you can see total depreciation will be maximum 90. Depreciation cannot reduce carrying value below salvage. This thing you know. But maximum we can give how much? Up, we cannot go below depreciable base. Intangible asset we have done this. Cannot depreciate below salvage value. Though in calculation salvage is not considered, but total depreciation cannot go below salvage. So now you can see that in IRS, current tax liability, what amount is shown in pre-tax accounting profit? Tell me. In year 1, what amount is shown in pre-tax accounting profit? Tell me. In pre-tax accounting profit, depreciation of 18 is subtracted. But as per IRS, it should be 40. So what I will do? I will add 18, subtract 40. So my taxable profit will come down or will it increase? Taxable profit. It will come down because I am claiming more depreciation. 18 I am going to add back. 40 I will subtract. So my taxable profit will come down. As a result, my current tax liability will be reduced. So I am paying today less. So tomorrow I will pay more. So I will create deferred tax liability on 40,000. Sorry. Deferred tax liability on 22,000. The difference. Excess depreciation claimed in income tax. Is it okay? Second year again it is reduced. Yes or no? So now I will create deferred tax on 6,000. If I see total, so I will create deferred tax liability on 28,000. 22 is of first year and 6,000 is of this year. Now this year I am claiming less amount. So my current tax liability is increased. Huh? Now I will create deferred tax liability on minus 3600, that is 24,400. Because this timing difference has reduced by 3600. You can make one column of timing difference. Rather, we can call accumulated timing difference. Here it is 22,000. Here it will be 28. Right? Again, my tax liability is increased. Again, my timing difference will be lower. Timing difference will come down. 18,000 I have shown, but income tax is considering only this much. By 9360 it will come down. So this is my new timing difference. So now I will create deferred tax liability on 15040. Now it is 0. So deferred tax liability on 0. Now one thing is very sure, this is balance sheet focused. It means if I tell you income statement figure, right? Create deferred tax liability on 22. Create deferred tax liability on 6,000, because we require 28. That too, listen to me, that too if my tax rates are same. Otherwise I will do closing minus opening. This year reversal of DTL on 3600. This year reversal of DTL on 9360. This year reversal of DTL on 15040. This is very important. This is accumulated timing difference. Because tax rate also might differ. But I have assumed that tax rate is same, so you can do like this. More addition means more creation. When it is getting reduced, it means it is reversal. Otherwise, what we have to do? It is like DTL on 22,000 minus 0. It is DTL on 28,000 minus DTL on last year. it is DTL on 24,400 minus DTL on 28 last year. Got my point? Just the reversal. So automatically it will come negative. It means it is reversal. It is DTL on 15040 minus DTL on 24,400. Then it is 0 minus DTL on 15040. Is it okay, everyone? Right? Clear? So let me just explain you once again. We are claiming more depreciation in initial years, right? More depreciation in initial year means initial year I am paying less tax, but future tax liability will increase. So that is why I am creating deferred tax liability. It is always balance sheet focused. The temporary difference will keep on accumulating, right? So here the difference was 22,000. If you see carefully, here the difference was 22,000. Right? Here the difference was 6,000. Here it is minus 3,600. Here it is minus 9,360. It is minus 15040. Right? So this is TD. But when we create deferred tax asset or liability, we always take accumulated TD. Because tax rate might be different for both the years. Suppose in first year I create deferred tax liability on 22,000 at the rate 30%. But next year tax rate has increased from 30% to 35%. Then on first year we created at the rate 30%, but tax rate has changed too. So that is why we go for this cumulative approach, balance sheet focused. So this is your accumulated TD. So first year it is increasing and then it is reversal of timing difference. See, negative. So we got balance sheet figure. Difference is income statement figure. provided tax rate is same. We can do it like this. If tax rate is same, with respect of TD, with the help of TD, I can create DTL or do reversal. But if tax rates are different, we have to go by this balance sheet approach, which is just here. There are two ways you can calculate income statement figure. Okay, the closing deferred tax minus the opening. Is it fine? So in which all cases DTL will be created, right? Let me just show you. DTL. Paid less today, tomorrow I will pay more due to these differences. Like just I showed you, SLM versus DDB. SLM is for books, DDB is for got my point? Investment under equity method versus cost method for tax. Accrual sales for tax versus installment sales for, accrual sales for books. Prepaid expense for books versus cash basis for tax. Now, goodwill tested for impairment versus goodwill 15-year amortization for tax. This I have told you when we did intangible asset. So these are the cases in which we have to create deferred tax liability. Right? And there are some cases where we are paying more today and we will pay less in future. DTA. Income received in advance for tax, books versus taxable right. We have allowance for books versus direct write-off method. Right? Now I told you we are balance sheet focused. Why? You know, because once we do it in that way, na, so changes in tax rate is also considered. Right? Like I just showed you here, na. We know the timing difference. Right? We know the timing difference. I can straight away create or I can reduce my deferred tax liability directly, provided my tax rates are same. But suppose if tax rate is in year 1 it is 30% and in year 2 it is 35%, then what we have to do? On year 1 which is already created, on that also I have to bring down that to 35. So that is why we go by this approach, closing minus opening. If tax rate over the years are same, we can straight away go for this timing difference and accordingly create deferred tax. Directly I can get income statement figure. See, this timing difference and income statement figure is exactly matching. See, this is my timing difference. Sorry. And this is my income statement figure. See, it is matching, yes or no? There is a timing difference of 22. We are creating deferred tax liability. There is more timing difference. We are creating again deferred tax liability. Timing difference is getting reduced. So we are doing reversal of what we created. But if tax rates are different, then we cannot do this. We have to do by this. This is created at the rate 30%. But this is created at the rate 20. On 28, we created at the rate 35. So on this 28, 22 is also included. So change in tax rate is also considered when I go by this. So out here, income statement is the balancing figure. Just like provision for uncollectible debts, like we did allowance for uncollectible debts, percentage of allowance on trade receivable. There are two ways of allowance. One is percentage on credit sales, percentage on trade receivable. So when it is as a percentage of sale, it is income statement focused. But when it is as a percentage of accounts receivable, it is balance sheet focused. Same here. If tax rates are different, balance sheet focused. If tax rates are same, directly on TD you can create deferred tax asset and liability. Please kindly have a look. हाँ. Is it okay? Okay.